Well, good morning, everyone, and thank you for joining Councillor Buchanan and Mitchell this morning. Today's presentation is entitled Grow Your Net Worth, Top Strategies and Planning Opportunities for Mid-Career Professionals. I'm happy to introduce our two presenters today, Alex Seleznev, who is a financial consulting and planning specialist at our firm. He's also one of the co-presenters on our market update, which we give every other month. And then Jordan Egert is also a financial consulting manager. He has tax compliance and strategy expertise. As with any other session, please make sure that you are muted throughout the hour-long presentation. And also, if you could also keep your video off as a courtesy to our presenters. There's a little video camera button. So just make sure there is a line through it so that your video is off. We'd like to thank those of you who submitted questions during the registration process. They've been sent to our presenters. If you did register early this morning or late last night, those questions may not have gotten to the presenters, so please feel free to use the chat box throughout the presentation today. This meeting is being recorded, and we will be sending the slides out later today, along with a link to an evaluation form. So if you wouldn't mind taking a moment to provide feedback on today's session, we would really appreciate it. So thank you again for joining us, and I will turn this over now to Alex and Jordan.
All right. Well, thank you. Thank you, Joe. Thank you very much. And thank you, everyone, for joining us on this beautiful day. As we're just chatting, I can't believe we're already getting closer to the end of the year, but it is what it is. So I guess for some of you, or for perhaps many of you are not familiar with our firm, we're comprehensive tax, financial planning, and investment advisory group. We actually merged with CBM. At this point, it's almost exactly 3 years ago, and it's been working out really, really well for us. We're very happy. And in terms of working with us, of course, comprehensive planning is what we do, but we also do consultations on issue-specific ideas such as, retirement planning, cash flow management, insurance, estate planning. We'll talk about those things today. And for some of our clients who actually want it, we can also take their accounts under management. Our team has 9 people, so we're growing. We have 5 certified financial planners. We have 2 chartered financial analysts. I'm one of them. And of course, we have many CPAs. We're part of a tax firm. One thing I always mention when I introduce us, we're a fee-only, fully independent firm, and that's important. If you ever work with us, any advice that we provide is prepared by our people in-house in our office. We do not outsource anything. And in terms of myself, I like to refer to myself as the investments guy. In practice, though, I spend more than 95% of my time on financial planning and investments. From our perspective, we always start with planning first, and investments is, of course, part of that. So before I ask Jordan to introduce himself, we want this to be as interactive as possible. So please ask questions, and we'll try to address as many of those questions as we can. And then also, I noticed that there are actually 2 CFPs who registered for this webinar. It qualifies for 1 hour of CE. So if you want it, please reach out to us, and we'll provide instructions on how to get it. So Jordan, please.
All right, thank you for the great intro, Alex. So Alex summed up what we do at CBM and also previously at May & Barnard quite well. We also do quite a bit of consulting work, a lot of strategy development and financial engagements and litigation engagements. We also delve into forensic accounting services as well. So it's kind of the dark side of the CPA world. I personally lead a large team at the firm. I handle all sorts of financial consulting engagements, tax strategy, compliance, and also just general feedback and implementation ideas for our clients as well. So like Alex has said, we've been doing this for quite some time. I've personally been with CBM May Barnard for 8 years. Alex is going on 9 years. And we always like to assist our clients as best we can. So that's how we came up with the idea for this seminar, was that we saw a need that needed to be fulfilled for our clients. We were able to give them some ideas and some topics and some food for thought, but there was kind of a missing link in how to implement it and kind of how to really take it to heart and put it into action. So our goal for today is just to give you some tools that you could put in your toolbox or consider as you're kind of building your net worth over time. So with that being said, we'll go into some of the topics that we're discussing today. And really, we're going to touch upon 7 items. We'll start with financial independence. We'll start talking about college and 529 plans, investments, estate 101. We're mid-career, so we're not going to go too deep into that. Career moves, strategies, taxes, and if we have enough time, we'll go into what it means for a second home or a vacation property and considerations that you need to think of as you're approaching that topic. So with that said, I'll turn it over to Alex to jump right into our first topic.
Thank you. Thank you, Jordan. And Joe, would you mind moving the slides to the 3rd slide, please? Next one. Okay. So what Jordan was referring to just a moment ago, that was actually one of the questions I was asking myself. Well, what is the purpose? Why are we doing this particular webinar? So what's interesting about it? Well, of course, education is one of the goals. We want you to become as financially sophisticated as possible. But then, one day I was watching my older son. He was on the couch watching Alice in Wonderland, actually one of my favorite movies. And there's this one conversation that I really remember, and I'll just read it to you. When Alice falls down the rabbit hole, very quickly she meets the Cheshire cat, and she asks the cat, "Well, would you tell me, please, which way I should go from here?" And then the cat responds, "Well, that depends a good deal on where you would want to get to, of course." Well, Alice says, "Well, I don't much care where." Well, then it doesn't matter much which way you go. And then Alice responds, "Well, as long as I get somewhere," right? And then finally the cat says, "Well, oh, you're sure to do that if only you walk long enough." And what's interesting about the story, this is where many people find themselves, especially in this mid-career group. Well, they're certainly going somewhere. They have some savings, perhaps they have children, they already have a home, or they're planning for a purchase, but frequently there are no clear goals in place, and perhaps even more importantly, there's no clear idea on how to accomplish that. So that is our objective for today. We want to provide more clarity. So with that, let's move to our first topic. On financial independence. And I'll tell you, we actually renamed it from retirement planning. And the reason that we decided to do it, for many people, the idea of retirement is just something, in the future. I very much enjoy what I do, and I'm, never going to retire. So when you start talking about financial independence, usually that results in a better conversation. Next slide, please. So how can you determine if you're on track or not? So what you're looking at here, this is actually a very brief summary of Fidelity's research. They really looked into their client base and try to determine, who's really on track. So by your age 30 to be on track for financial independence, you're expected to have close to 1 times your salary in savings. Your gross salary. That's important. So if you're earning, $75,000, well, you're expected to save $75,000 by your age 30. 3 times by your age 40, 6 times by the time you turn 50, and then 10 times by your age 67. And what is so special, by the way, about 67? That is considered to be this full retirement age when most people are expected to retire. So perhaps you can quickly do the calculation and figure out if you're on track. Now, for those of you who are starting to save early, you can also look at it from the perspective of your ongoing savings. So the minimum that you need to track is 5% of your gross income to have some chance of success. Somewhere between 10 to 20% would be the preferred percentage. And actually, when we originally presented on this, I looked at a couple of plans that we prepared, and that's essentially the ballpark. And then if you ever find yourself in a situation when you're saving more than a quarter of your earnings, well, you have a very high probability that you're on track. Yeah. the important assumption here is that you started saving early. And we'll talk about different strategies and how to catch up if that's not the case. Next slide, please. So what you're looking at here, and I've seen dozens of these, graphs or tables in the past, but every time I see something like this, it always fascinates me. So you have two investors. You have Ben and you have Arthur. Both of them started saving, at an early age. Ben at the age of 19, and then Arthur at the age of 27. I frankly do not know very many 19-year-olds who are, saving, but in any case. So Ben only saved for 8 years. Arthur started at the age of 27, and then he kept saving all the way to age 65. But then you look at the difference, and that the figures by themselves are quite astonishing. Ben is expected to have almost $2.3 million versus Arthur, who's also not doing all that poorly, at more than $1.5 million. So the difference of more than 700,000 because again, Ben decided to save early. Again, that's the power of compounded interest. Next slide, please. So there's definitely, so what we talked about earlier, some of the rules of thumb of how you can determine if you're on track or not. Now, if you ever find yourself in a situation when you significantly undersaved, and that is quite common. Perhaps you're responsible for raising your family, you're trying to advance yourself in your career, any other reason. So you find yourself in a situation like that. Those rules of thumb are not likely to work well for you. They may simply not be appropriate. Again, we'll talk about how you would actually do that. Now, if you want to have a specific lifestyle, and it really goes both ways. If you want to live in a high-cost area, such as our area, or perhaps you want to move somewhere else, well, you'll be approaching it differently. Great example of that. One of our recent engagements, it's a government contractor, and he's planning on working here for the next 10 to 15 years. He's originally from Georgia. Most of his family members are in Georgia. So once he is done, he is going back to Georgia. So for him, we would be approaching it in a very different fashion. And of course, if you find yourself in a situation when you're expected to have some kind of pension, rental income, any other sources of income, or perhaps you're expecting to receive some form of inheritance, again, you want to incorporate that in your analysis. In all of these cases, you're probably better off having an actual plan in place of how you're going to accomplish that. Next slide, please. So this is actually one of the popular questions or discussions. Again, you find yourself in a situation where you significantly undersaved. So how do you catch up? So what you're looking at here, think of it as a checklist, and we would actually approach it in this order. I can see how some of you would think differently perhaps, but we would approach it this way. Step one is to ensure that you're working with realistic assumptions. A good example of that, well, some people assume that their portfolios will be earning 15% in the long run. It's certainly possible in any given year, but when you're basing your projections on that, well, is that truly realistic? And then on a smaller scale, again, this conversation I recently had with one of our tax clients, she was switching jobs. She wanted to talk about how much she should be saving in her 401k, and she wanted to increase from 3 to 5% in terms of her savings. Well, that's great. But again, it's quite clear that she, undersaved, and saving, a few $100s more each month in this particular case is not going to be all that helpful with accomplishing her goals. Now, if you don't know where to start, you just don't know where to start. In many cases, the best place to start is by maximizing your 401k, 403b, or TSP contributions. If you work for government, you would be doing it presumably on a pre-tax basis. In many cases, or at least in some cases, your employer would match some of those contributions. And of course, any growth in those accounts would be tax deferred all the way to your age 72. Very powerful. Now, the next concept here, the idea of paying yourself first, I find it quite powerful. But let me explain how it works. So, under a traditional approach, let's put it that way, you earn, money, your wages, your self-employed income, anything else you have. You pay taxes, of course. Then you spend on your living expenses, housing, travel, anything else, and then you save the rest. So the main issue with this approach is that in many cases, it looks good on paper when you run projections, you look at your cash flow, but in practice, it doesn't work. People tend to overspend. So what if you approach it differently? Again, you earn what you earn, you pay taxes, then you save, you pay yourself first, and then you essentially spend the rest. And what I discovered when we work with someone, we develop a plan for them, and let's say it doesn't work, they reach out to us next year to talk about it. That is what I would frequently propose. How can we set it up so that you pay yourself first? And as you can see, the next bullet point here, how can you do it automatically? That's also important. Anything that is set up to be done automatically has a much higher probability of success than if you do it manually. Investing more aggressively, we have to be careful here. Again, it depends on your actual risk tolerance, your time horizon. One good example here, we worked with a client who was in her late 50s. She significantly undersaved, but she was a high earner. So we suggested that she saves close to a quarter, actually more than that, of her income and invest in growth-oriented stocks, stock funds. Usually we wouldn't recommend something like that for people that age, but in that case, it was necessary so that she could catch up. Reducing your expenses. Well, perhaps I don't need to go in much detail on that. In some sense, it goes without saying. If you have a lot of credit card debt and you're spending more than you're earning, you need to look into that. But notice again, it's closer to the bottom of this list. The idea of downsizing is there, and especially now, when many of us are working from home, and perhaps we do not need to be all that close to our actual employer. So that's consideration. And then finally, if you try all of these things and it still doesn't work for you, well, perhaps, yes, there is a possibility that you need to get a second job or change your employer, change your career, move in a different field. I have a great example of that. A couple of years ago, one of the government employees, one of the government agencies, he came to a meeting and essentially he prepared everything for me. I was the one, listening to him, making comments. It was essentially doing my work. But whichever way we tried to run the numbers, it essentially never worked. He would have to save, close to half of his earnings to accomplish his goals. So the only approach for him was to essentially change his employment, which is, by the way, what he accomplished. So he's moving in the right direction now. So in terms of the key takeaways here, well, at this point in time, you're a mid-career professional, make sure that you fully understand your situation. Make sure that you're on track and make sure you understand your goals. If you still do not know where to start with maximizing your pre-tax contributions. That is frequently the best place to start. And then finally, if you have any specific goals or if you want to become financially independent sooner, well, chances are you really need to have a plan in place.
All right, so on to me for college 529 planning. I just want to touch on for a moment some of the items Alex had discussed. We'll actually talk about those a little bit more as we go through our presentation and our seminar, really on what it means to change jobs and what the value is. And something that I wanted to point out that Alex is a huge value add is just how meaningful it is to maximize your pre-tax benefits to your employer, because there is nowhere else in the world where you can get 100% return on your dollar if it's getting matched by your employer. And that is an astronomically phenomenal return. So if you have the aptitude and ability to do that, by all means, take advantage of your match first. Okay, so lots of questions on 529 plans and catching up for education. So let's delve into that a little bit. So some of the numbers I just wanted to run by everyone to show you how important it is to be saving and having a plan for your college goals for your children or your grandchildren, is that in 2020, the average student loan debt was $37,000 for each student that left a four-year program. That's after scholarships, after grants, after everything's been accounted for. And they're paying on average $400 a month towards their student loans, which I think now is actually closer to $500 a month. So to start someone off on a path to have such a burden of debt isn't exactly a great way to ensure that their financial goals and their financial road to financial independence is set for them. You know, it's kind of a two-way street where you want to make sure that your kids and your dependents and your grandkids and whoever else you have 529 in college savings for are set up correctly. Okay, Joe. So what is actually a 529 plan? We talk about a high level, but really it's a sponsored state or educational institution sponsored plan that allows you to have tax-free, or in some cases tax-deferred savings inside an investment vehicle. So basically what that means is you could put $1 in today, grow it to $1,000 18 years from now, and then when the time is ready to use it for qualified educational expenses, you can utilize that account without having any tax ramifications. So it's a great way to kind of supercharge your savings, and we'll go through an example in a moment, without having the burden of taxes or worrying about in the other prepaid tuition plan, any sort of risk that may be involved with investments in the 529 plan. So there's two flavors of this. We'll talk about that in a second. There's savings plans, prepaid tuition plans. The savings plans, basically, it's like your taxable brokerage account, or in this case, a tax-deferred brokerage account, where basically you're controlling it, you're saving it, you're directing it. Prepaid tuition, on the other hand, there's no real investment options available. You're basically just trying to pay in enough, and then in the future, the program says, okay, you've paid in X dollars, we're allowing you now to have 4 years of tuition free, 2 years tuition free, whatever the program caveats are for that. We'll talk about that in a moment as well. So Joe, if you don't mind staying on that slide for just one more moment. We'll talk, and just the last point, there are tax deduction benefits available for taxpayers, meaning if you have a contribution to a state-sponsored plan, you may actually get a tax deduction for it. And we'll also talk about that later. So let's go on to the next slide. So what was shocking to me is really sitting down and doing a number similar to Alex's exercise earlier, where contributing earlier on pays dividends later in the game. So right now, the average cost of a four-year college program, about 16 to 18 years, will be projected at about $165,000. So that's tuition, that's books, and that doesn't include housing costs, food costs, transportation costs. That's above and beyond. So why am I showing you this figure? Well, if we take a look and we say, okay, well, you know, I'm not going to start a 529 plan now. I'll start it maybe a couple of years later, or you never really get to the point of funding a 529 plan or funding a savings, an investment account to use towards 529 purposes or college purposes, then you could fall in a position where, hey, I need to save this $165,000. If you're saving it in a savings account, chances are you're coming up with $86,000, $87,000 at the time you need to accumulate those assets for tuition purposes. And that's because a savings account right now, as some of you know, are paying somewhere in the realm of 0.01% to 0.2% if you're lucky. Whereas in an average 529 plan, it's effectively like you're purchasing stock or fixed income securities, and you have more ability to have a larger rate of return. So when we look at this, in order to accomplish attaining $165 some odd thousand at year 2036, we would need to save now $420 a month, and that's assuming a 7% rate of return. This is a little bit different if we assume a more aggressive rate of return, which Alex touched upon earlier. If we go upwards and have a more aggressive strategy and have more close to an 8 or 9% rate of return, it's possible that instead of $420 a month, we really only need to put $300 or $250 a month into our 529 plan. Okay, so let's go on to the next slide, Joe. Alrighty, so this is kind of mind-blowing. So let's say we have zero savings at all, and we didn't really take it upon ourselves to have a separate carve out for college for our kids or for any dependents. And we say, okay, we're gonna have you, pick yourselves up by the boots and pay for your. If we do this and we not pay for any sort of college, any tuition, any books, our child or our grandkid will graduate with $220,000 of student loan debt payments by the time they've paid down their loan to zero. So compare that with putting $400 a month in for 18 years. There's an astronomical difference in the amount that you would put in, which is $86,000 of principal versus the amount they would take out of $220,000 in student loan debt and interest. So just keep that in the back of your head about how large a discrepancy or variance there is between, at least putting something forward into 529 plans or into a savings account versus having your child take on student loans.
Right.
All righty. So let's go. This was okay. So Peter had a question. I'll take a look at that as we get closer to the end. Thank you for asking about the 529, Peter. So regarding savings plans versus prepaid tuition, it's really kind of a cut and dry situation. One, you're trying to hedge your bet against inflation and increased cost of tuition by using a prepaid plan. Again, it's just fixed contribution, and then you're getting whatever the tuition is for free. The savings plan, you have more control. There's no age restrictions on a savings plan. Prepaid tuition, you might have an age restriction. So just take a look at this chart. It's really nice to kind of walk through and compare what might work best for you. The one caveat I will say is that we're in sort of this gray area, is if we have a prepaid tuition situation and we have a complete reform in a college education process and a tuition process, prepaid tuition might be, something that gets revamped. So it may not look like what we're seeing it as today. And that's up, we'll talk about that a little bit later for some of the tax reform that's on the table as well. Okay, so when we talk about the contributions and deductions, we just touched upon that some of them are tax deductible. If you live in a state where you have a state-sponsored 529 plan or savings plan that you contribute to, you could be eligible for a deduction under state income taxes. So for example, in Maryland, if you contribute $2,500 to a 529 plan, you get a $2,500 deduction on your state income tax return. If you contribute more than $2,500 for one person and one plan, you can carry that forward. So if you contribute $3,000, you can carry over the $500 deduction to 2020 or 2021 and use that as a state income deduction. Something to keep in mind now too, which was a really interesting modification due to all the COVID tax reform, is that now 529 plans aren't specific to college education. It's been expanded now to include kindergarten to 12th grade. It's now been expanded to also include $10,000 of student loan payments. So it's a really nice way to kind of utilize that fund if you have these expenses prior to college. And even now, we can also take advantage of this by setting up a 529 plan for ourselves. Let's say I'm 45 years old, I still have student loans. I could effectively put $10,000 into a 529 plan and then pay my student loan by $10,000. And now I just created a deduction for myself by doing a simple in and out into a 529 plan. So it's a really interesting way to kind of, I would say, arbitrage your tax situation or really utilize 529 for other purposes aside from college savings. So with that, I'll turn it over to Alex to discuss some investment strategy.
Thank you, Jordan. So quick disclaimer here, I'm about to talk about investments here. Everything we're about to discuss is for informational or discussion purposes only. I'm not in a position to provide any specific advice here, so please keep that in mind. And also, the assumption that we would be making here is that you already have at least a basic understanding of what a mutual fund is or what an exchange traded fund is. If that's not the case, that's fine too. You will still benefit from this information, but I just want to make that clear. So again, at this stage in life, you're a mid-career professional. Chances are that you should be investing for growth. And I very much hope that this sounds, obvious to you. For those who are perhaps in their pre and post retirement years, for those people, usually it's for income and or preservation purposes. But at this time, it's really for growth. Now, in order to ensure that this is really the case, you really need to have a full or good, at least good understanding of your current asset allocation, which is essentially the split between your stocks and bonds. Now, why is this so important? Well, there are lots and lots of studies saying that somewhere between 70 to 90% of your long-term performance results can be explained by your choice, essentially by your selection between stocks and bonds. Not by market timing, not by how well you can pick your investments, but essentially the split between your stocks and bonds. Now, when you start investing for growth, you have multiple options, of course. The way we structure at least most of our portfolios, they consist of mutual funds and exchange-traded funds. Essentially, you can accomplish all of your financial goals by limiting yourself to those types of investments. That said, every so often, someone would reach out and say, well, look, Alex, I have this 3 or 5 stock ideas. What do you think about them? I'll tell you, more often than not, we'll look at them and we'll say that's fine. Let's pick a couple out of what you're proposing, and that's fine, as long as this person already has, again, a reliable allocation in place. The problem with stocks, individual stocks, is their performance is much less predictable compared to, again, mutual funds or exchange traded funds. And again, the problem is it's not that you just pick those 3 stocks and they perform poorly. That's, of course, part of the problem, is that you're not participating in the market expansion. And what you can see on the bottom of this slide, the S&P 500, which is considered to be the benchmark for the market, is up 11% for the past 10 years, but specifically growth-oriented stocks, we're actually up 17%. This is annualized, versus value or more dividend-oriented at 9%. So again, it's important that you're investing for growth. One of the issues I see quite frequently, again, for those mid-career professionals, is target date funds. There's nothing wrong with target date funds. I have nothing against them, but here's a potential issue. Let's say we're speaking with someone who is 50 years old. This person been working for company X for the past 30 years and accumulated significant funds in his or her target date fund. Well, usually at that point, it would be something like target 2040 or maybe target 2035. That's the age when the fund expects you to retire and basically begin taking the funds out. A good third of your portfolio would be in bonds, or basically in things that are perhaps not expected to grow that much, and especially given where we are with interest rates at this point, like Jordan was saying, that you would be earning perhaps less than 1%. Again, is that what you're really trying to accomplish? Are you comfortable with, let's say, a third of your portfolio essentially earning nothing for you? And perhaps the answer is positive. Perhaps that's what you're trying to accomplish. But again, I encourage you to take a look at your target date funds, if you have any, and ensure that they're appropriate for your specific investment purposes. Annual rebalancing. That is one slide back. Thank you. That is so important. That right there, Joe. That is perfect. And essentially, what that is, this is a systematic way of selling high and buying low. So what happens is, let's go back to the end of 2019. Of course, 2019 was a very good year to say the least for the stock market. If you're rebalancing your portfolio, you would be selling those types of investments that appreciated most, and you would be buying those types of investments that perhaps did not appreciate that much. Not many stocks were down in 2019. Now, in March or April of this year, if you're rebalancing your portfolio, you would be doing the opposite. You would be selling your bonds, perhaps, if you have any in your portfolio, and you would be buying stocks. You would be rebalancing your portfolio. Now, there was this study by Vanguard, actually. Vanguard released that study, and they started multiple business cycles, and they're basically saying that doing this at least annually can potentially increase your long-term rate of return by as much as 1%. So that is a potential free lunch for you. And again, as I mentioned earlier, and we'll discuss an example in just a moment, make sure you understand the difference between so-called growth-oriented and more dividend-oriented investments. It can be quite significant. Why is this important? And I just looked at one of the funds, one of our clients for 401k plans. It's called a Parnassus Capital Appreciation Fund. Right? It's actually a good fund. But what does that mean? What does capital appreciation mean? And if you really look at the fund, well, it actually invests in so-called bargain securities with the goal of those prices going back to their original valuation. It's not necessarily a growth fund, even though the name of the fund may imply it. Next slide, please. So there are multiple tools to analyze your funds, to analyze your portfolios. We use Morningstar Advisor Workstation. It's extremely powerful. And by the way, you can access it as well on their website, through their retail program. So what you're looking at here, these are two portfolios, essentially. On the left side is let's call it a growth-oriented allocation. And on the right side, it's more of a balanced allocation. Well, why am I saying that? Well, again, if you add up what you see on the right side, 36 plus 11 plus 11 gives us 58% again in growth-oriented investments. If you look at a balanced allocation, well, we have only 45% in those types of investments. I'm certainly not saying that one is better than the other. Perhaps the more balanced approach is more appropriate for you. But again, the first one will likely perform at a better rate because it invests in more growth-oriented investments. Next slide, please. Okay, so this one, I'll tell you, this is not something that you'll likely be discussing with your colleagues. That's not one of those more glamorous topics. Or tax efficiency. So, location. Usually we're referring to real estate, but it also applies to where you would be buying different types of investments. So the way we would approach this would split your accounts in two categories. Your taxable accounts, your tax deferred accounts, 401k, IRA, and we want to do it as tax efficiently as possible. In your taxable account, if you prefer to keep your reserves, that's a good place for that. For any of your, I refer to them as buffer investments, anything that is liquid and readily available for your cash needs, maybe short-term bonds. Passive mutual funds or index-based mutual funds and exchange-traded funds are great choices. They don't trade that much inside of the fund, and as a result of that, they don't generate that much in capital gains. Same for mid and small cap stocks, because many of them they're not necessarily making any significant dividend payments. So again, you would not be taxed on those every year. And then in some sense, the opposite for your tax deferred accounts, that's where you would want to keep your dividend oriented stocks, such as large cap stocks. If you prefer to invest in actively managed funds or strategies that trade inside of the fund quite frequently, especially for those that are invested in emerging markets, that is a good place. In short, if you have two accounts, you have a taxable account and you have your 401k. If you look at them and your investments in both accounts are the same, meaning 80% stocks and 20% bonds, and the same here, chances are you're not invested in the most tax efficient manner, and that can cost you quite a bit in taxes. So take a look at that. Next slide. So finally, in terms of the, some of the takeaways here, we strongly recommend that you review and potentially rebalance your portfolio at least annually. In times of market volatility, we recommend that you do that more frequently, actually. Asset location is important. And if at this point in time, perhaps you don't have that much in your investment accounts, that's fine, but start early. Give it at least some thought. And then finally, if you actually want to invest for growth, well, make sure that the investments you're picking are actually growth oriented. It may sound obvious, but in many cases that it's not the case, because again, the names can be quite misleading. The good question here. We will also address this question at the end. Okay. So thank you for your question. We will address it.
Alrighty, so on to estate planning. So we won't get too far into the depths of what estate planning means, but really we just want to touch upon it because it is important to have some consideration for at least some of these items that are up here. And what comes down to it, I mean, it's a big decision. It's an important part of your life planning strategy. If we're smart about it, our planning helps not only protect our families, protects net worth, protects the future, really your legacy. So the big takeaway is if you don't have something in writing or you don't have a plan, someone else is going to make it for you. And I can guarantee that person making it for you is not going to replicate what your wishes and desires are. So the big couple items that we should talk about right now is that everything you have, you should inventory and document. Your assets, your liabilities, you should have an ongoing list. That way, in case of any predecessors or anyone that's tied to your estate or wills or trust understands what they have to view, what's there, what's available. I'll skip ahead, and the important takeaway is we should also be able to write it out, physically write it out, have a lawyer look at it if we actually need to get that involvement, and make sure your directives are in place. And the big ones for us, at least from a directive perspective, is that we need to have a durable power of attorney on hand, or we need to figure out if we have a DNR, do not resuscitate. We need to have our wills in order. We need possibly a revocable living trust, or even a financial power of attorney, someone that can act on our behalf to make tax decisions or investment decisions if we're incapacitated. I always suggest, maybe once a year, once every couple years, as you start approaching your 40s or 50s and even into your 60s, really reassess and review what your thoughts are on who may inherit items or how you wish your assets to be distributed upon your death. So, Joe, if you don't mind going one ahead, thank you. I just wanted to give a quick rundown of what happens if you don't have a plan in place. First person, I'm sure everyone's aware of Prince. I actually remember seeing his concerts many years ago over on 14th Street over here in DC. And the interesting thing with Prince is that there was nothing in writing. He had absolutely nothing. He just had a huge, huge estate with over 20 heirs to it. And what happened was there were thousands of lawsuits, thousands of creditors, thousands of cases trying to grasp at, what was a massive estate. So it's still ongoing and no one has really accomplished anything. So it's kind of an issue that you run into from a legacy perspective if you're trying to leave a clean slate for everyone. The other issue that I've seen working with clients is that there's kind of conflicting directives provided in our trust and our wills and our estate planning documents, where our documents could establish that we want A, B, and C to happen, but then we leave some sort of gray terminology in it. And that's what happened with Princess Diana. She had actually left a letter of wishes to her executor that at their discretion could provide to her heirs assets or other items. And so what ended up happening is that the executor effectively just gave out little trinkets to all their heirs and effectively swindled them out of their inheritance. So just something to consider when we're talking about estate planning. We can talk about this more at the end. I'm sure there's quite a few questions, but keep in mind that estate planning isn't only for yourself, It's also for your legacy, like I said earlier, for your kids, your grandkids, charitable funds and other charities, colleges, education programs, and the like. Okay, so let's go on to career opportunities. Alex talked about this earlier, and it was actually a very, it's an interesting topic because we can always take the high road and say, all right, I'll just get a job elsewhere and increase my income. And Joe, if you don't mind advancing one slide, thank you. And so it's an interesting perspective in that we say, okay, well, we have a job offer, let's just go and grab it. It's another $50, $60, $100,000. Makes sense on paper, let's go for it. Well, what we also have to consider on the next slide is that not all money is the same. And I'm going to go through some strategies and some tools that you can use in analyzing, what it means for getting another job. So let's say we're in DC as a single taxpayer making $150,000 a year. And we go over to Alex and say, hey, I need to figure out how I can ramp up my savings. What's the real meaningful way to go about this? I have a job offer in San Francisco for $200,000. I have another job offer in Memphis, salary $75,000. I don't know what to do. Well, the way we can look at this from a financial and numbers perspective is looking at the index or the cost of living indexes of each area. So Joe, if you can click once. Thank you. And so these cost of living indexes are relative to a base level. So at index 100, that means you're at an average cost of product, an average cost of lifestyle, an average cost of housing, etc. So in DC, we know the index is 161. San Francisco, the index is 240. Memphis, the index is 77. So what this means is San Francisco is almost 75% more expensive to live in. Memphis is almost 50% less expensive to live in. So the formula, and let me dial back a second. This information is available online publicly. There's multiple sources to pull it from. The important factor is that you pull it from the same source. You can grab it from Department of Labor, the Board of Statistics, local city councils, etc. So much of the information I have here came from some statistics from Department of Labor. So when we're thinking of comparing what it means to have a $50,000 raise in San Francisco versus DC, we use this formula. We say our local wages of $150,000 times the ratio of the cost of living index of San Francisco or Memphis over the cost of living index in our location, DC. That's what your wage equivalent needs to be in order to make sure that you're still on parity with at least meeting where your salary is in your location currently. So let's see how this gets put into action briefly. On the next slide, Joe, there's a couple levels of doing this analysis. One is that we just simply look at it from a straight salary perspective, which is a huge detriment because, as we all know, there's tax ramifications on our earnings, and there's different thresholds and different brackets based on your tax, based on your salary and earnings. So at $150,000, your taxes may be less than they are at $200,000, or at least your tax brackets. So the way to really broach this subject or approach it is looking at it from a net pay perspective. So in DC, we might have $100,000 or so of net pay. San Francisco, $132,000. Memphis, $60,000. So on face value, obviously San Francisco looks like the way to go, right? So that might not be the case because now we have to start looking at the wage equivalents. So once we look at the formulas, we see that our wage equivalent, we're basically good to go in Memphis because after we crunch the numbers and we do our ratios, our cost of living equivalent is how much you would need to net to equal what I earn in my current city. In Memphis, you would need $49,000 to meet the same lifestyle you have as in DC. And so we see that our net pay is $59,000. we're $10,000 above and beyond what our wage equivalent should be. So at the grand level, at the big picture level, it might make sense to consider that. Obviously, there's other considerations, which we can talk about in a second if you go to the next slide. We should also consider 401k contributions, HSA contributions, really anything at the federal level that's a deduction for us, and then compare it. Because once we do that, we see that it changes the cost of living equivalent and may not make sense any longer to live in Memphis, which is the case here. Now you need $39,000 and you're netting $36,000. So both bad situations. So it makes more sense in this specific instance and excluding other variables to just stay in DC. So let's go ahead 2 slides.
Jordan, we're getting closer to 11:55.
Perfect. That's just enough time to jump into taxes and then we're out of here. So,
and we do have questions, by the way, everyone. We will not forget about your questions. We have like 8 or 9 of them.
Perfect. So just keep in mind too that it's not all about the money. Think about the non-financial impacts, any sort of non-salary based considerations, bonus structures, retirement packages, fringe benefits, deferred compensation. They all have a value to them and it's not really apparent on the front end. So that's something you want to consider when you're establishing your goals over the next 5 years, 10 years, 20 years. And most importantly, the best benefit is making sure that you have the coffee that comes along with all the other perks. So Joe will go ahead. Okay, so taxes. I just want to jump into this because this is a massive, massive concept, and we're going to try to break it down into 2 or 3 minutes for you. So Joe, go ahead once. Perfect. So we had all sorts of tax reform these past 2 years, and it is just crazy what's going on and continuing to go on. But really the takeaways, we're limited now on our mortgage deduction up to $750,000. So if it's important to you to maximize your deductions, just keep that in mind when you're taking on a mortgage. Sales and local tax, state and local tax is now limited to $10,000 on your itemized deductions. Why is that important? Well, if you live in DC and you own a house, chances are you're being limited on your deductions on your itemization. So that's kind of up for grabs, and we'll talk about that in a second, to be modified that there would no longer be a SALT cap, which is state and local tax. Okay. I love Morgan Stanley. They always say you can pay your taxes, but there's no rule that says you have to leave a tip. And that's my big takeaway. Just some other food for thought. If we're really trying to kind of keep assets in our pocket, right now, thanks to COVID, we have a couple items that came up, and one of them that was interesting was something we could share with our parents, is that the required minimum distribution has been lifted. So we don't need to take assets out of our inherited IRAs or our standard IRAs and 401ks. And that's basically pushed back for 2020. It kicks back in 2021. So the big item at hand, the Trump versus Biden tax considerations. We'll talk about 1 or 2 items. I'm impartial either way. So we don't have any which way that we side with, but just know that there are planning opportunities right now. Under Biden, the proposed idea is for capital gains. Once we exceed $300,000 or $400,000 of income, that the capital gains goes from 15 or 20% tax up to your ordinary income tax rate. So if that happens, now you're paying 36, 40% some odd in tax just because you have a high income. Something to keep in mind. And there's still time to strategize on that if there is a change in presidency. Okay, there's also, Biden has proposed the removal of the state and local tax cap, kind of a give and take situation with the capital gains item as well. So there is some planning, and I think once we approach November 3rd, we'll have a little bit more conceptually in what we can put into practice. All right, let's go on to the next slide, Joe. I have a little cheat sheet that I always keep on the side of my desk. I just want to give it to you guys on the slides. Really nice way as we're approaching year end to kind of take a quick look at this. Maybe it makes sense to consider some capital loss harvesting if we do have losses in the market. I always like to consider contributing to an HSA plan. Really, if you have unreimbursed medical expenses, you can contribute to your HSA, pay yourself immediately back out of that, and then receive a tax deduction for it. There's also the solar energy credit that goes down to 22% January 1st. It's a really nice way to go green. And specifically in DC, you're able to also receive an income string off of there for selling the energy efficient credits or SRICs that come off it. Something to consider if you're trying to figure out how to continuously arbitrage your tax position while also going green as well. Okay. So next slide, this is just touching again on the tax planning strategies for 529. Keep it in your back pocket if you're trying to figure out the best way to maximize your state tax deduction for a state-sponsored 529 plan. There's different ways to approach it depending if you're married, if you're single, if grandma's involved. And just you can review it and see how to maximize it to minimize your tax burden.
Jordan, so do you think we should address, we have a lot of questions, should we address the questions first and then go into the second home? What do you think about that?
Sure,
we're already at the 1 o'clock mark.
Let's do that, Alex. Let's touch upon a couple questions first.
Okay. So the first one.
I'm sorry, let's talk about the ones that are in the chat first, if you don't mind.
Yeah. So the one, and by the way, we will not mention your names again because we're recording this. So Jordan, go ahead. All
right, so I'll just read this out. So even if we're over the income limit to deduct IRA contributions, it's worth investing in them instead of a taxable account in order to avoid taxes on dividends, for example. So that's a big question. My answer is it depends on your total financial plan. There's no one-stop answer for that. And I think Alex can touch upon a little bit more on what it means to avoid taxes on dividends inside of 529. I'm sorry, inside of tax.
I will address this question. So depending, of course, on your specific circumstances, in many cases, the answer would most likely be yes, then no. And the reason that's the case is because even if your contribution is non-deductible, you have at least two choices or two benefits. The first one is that the funds of the IRA itself would still grow tax deferred, right, all the way to your age 72, where you can where you'll be required to take the funds out. And then the second piece, which is quite interesting, one of the reasons we'd almost always recommend that there's a possibility for you to do a backdoor Roth conversion, which works quite nicely for some people who have access to a 401k plan. And of course, their income limit is above the threshold, so they cannot actually deduct it. In terms of the investment question itself, I'm not sure if there is an answer to that. Yes, you would prefer to keep your dividend-oriented investments in your IRA. So that's my answer.
Okay.
There's the earlier one, Jordan, and I believe this one is perhaps for you.
Sure.
Despite the
go on, Alex.
All right, I'll read it and you answer. Despite the significant cost of borrowing for college, what's your response to? You can borrow from college, but you cannot borrow for retirement, suggesting that it's still wiser to invest in retirement than invest in a 529.
Sure, thank you. And that also comes back to it depends on your financial plan. There's all sorts of questions that you need to ask before you can even jump into that. Are you caught up on retirement? Do you have enough retirement? Have you saved enough to meet your goals once you hit 67 or 62, whenever your retirement age is? It's a little bit tough to answer or direct that question, but depending on your circumstances, it might make sense to super or front load your 529 plan or just regularly contribute to it. But there's a balancing act as well. The 529 plan is great for having tax-free distributions and tax-free growth, but that's also what the retirement vehicle is for as well. And we were talking about borrowing for retirement. It's not that you can't do that. There's ways to structure it to arbitrage cash or arbitrage your investment accounts if you're trying to borrow to fund your retirement. Not that we recommend doing that, but again, it comes back down to what's your financial picture now? What's your financial plan in the next 20 or 30 years?
Right. So I guess I'll address the next one. What is the best way to diversify stock investments by sector of the economy or several tech companies for blue chips, if there is still such a thing? Okay, I hope I understand the question. So we diversify, the way we do it, I'll just explain how we do it. We do it by sub-asset class. So we essentially divide the entire universe of investments into 9 categories. The most conservative would be the so-called large value stocks, stocks such as Walmart, to make an example. And then the most aggressive would be those that would fit into the small growth category. And then depending on your, specific objectives, we would basically be creating an investment mix for you based on those, again, sub-asset classes. I'm not sure if I understand the second part of your question, so I'm gonna skip answering that part.
All right. So we have a couple other questions, Alex, that were submitted beforehand. So let's take 2 or 3 of those, and then if anyone likes, we can continue on for 2 or 3 minutes inside talking about second homes, and then we'll wrap it up from there.
All right. So here's one for you, Jordan. Should a person have a Roth in addition to a 401k account?
Okay. So I will, I guess, qualify this by saying it depends. Everything always, it depends. I'm a big proponent of having both. I like having a mix of Roth, of traditional, of taxable taxable investment accounts. It gives you the most opportunity to leverage any sort of tax reform or any sort of tax opportunity and create an arbitrage situation. For example, if you only invested and put your money into a Roth 401 or a Roth IRA and you have a low income year, you can't consider doing a Roth conversion. It might have made sense to have your traditional IRA and then roll it and convert it over into a Roth IRA tax-free. So there's all these circumstances where having some of each asset can make sense. And I always recommend, if you have the ability to have multiple buckets, to set up multiple buckets. And is that how you feel too, Alex?
Well, that's right. I mean, conceptually speaking, both are great, of course. But Jordan, this time I entirely agree on the "it depends" answer. So it really depends is the answer. So the next question is it better to pay off your home early or invest additional funds? So I will take this one. Here again, you can always say it depends, but from the purely mathematical perspective, chances are you can do better in your portfolio compared to your mortgage rate. So to make a specific example, let's say you're invested in a balanced asset mix that in the past at least earned somewhere between 6 to 7%. If you have a mortgage where you're paying 3, maybe 4%, well, again, mathematically speaking, you're better off investing. There are some tax caveats to that, what Jordan talked about just a moment ago. Plus there's this whole movement of people who are trying to become financially independent, the so-called FIRE movement, and the idea behind that you essentially have no debt, so you always focus on your debt first. But from our perspective, again, mathematically speaking, you're better off investing the money.
Right. And the other viewpoint of that, Alex, too, is more of an interesting holistic viewpoint, is that paying your house is effectively paying off or creating a fixed income stream. So
right.
One might take the viewpoint that maybe they're 100% invested in equities and then instead keep their mortgage as long as possible and treat it as their fixed income component of their financial picture. So just food for thought on that item.
Right. And this is, I guess we'll take this last question and dive into the second home. A little interesting. Does purchasing a second home make sense as part of the catching up strategy? Well, that's a very interesting question. And the reason I'm saying that, if you find yourself in a position that you're able to afford a second home, well, I'm not sure if you're necessarily catching up. So it's interesting how someone would address this question. Again, these two are entirely different types of investments, right? When you're dealing with your portfolio versus when you're dealing with your real estate. I will give you a short answer. I do not, at least I cannot recall very many people who are able to accomplish the goal of catching up by buying a second home. That would be my answer to that question. I don't know, Jordan, we have a section on that, so perhaps you have more to say.
We'll just kind of jump into some of the second home discussion. We'll kind of keep it pretty light and talk about for a minute or two. But really what Alex is alluding to is that, you know, if you're at the point of considering second home for tax arbitrage or for financial gain, you need to be prepared to have that. And what we mean you need to be prepared is that, you know, you need to make sure that you are above and beyond position to account for any sort of road cost, any sort of capital improvements or damages or repairs that come about of your house. And you have to have a plan as to figure out why you're actually investing in a second property. Is it for rental purposes? Is it for vacation purposes? Is it for estate purposes to have a place for your grandkids and your grandchildren to come to? They all have meaning as to how you kind of fit that into your financial profile or your risk profile. So when we talk about a second home, some of the caveats, every single time I've done this analysis or had this conversation, people expect to budget down to the dollar, and that never works. So if you can afford a $500,000 house, people are expecting to spend $499,000 on it. My recommendation is that you dial down your budget or what you're thinking you're spending or projecting your earning from rental income from your second home by 25% to build a significant buffer in. And you also need to make sure that you have on top of that emergency savings for furnishings, reserves for capital improvement setup, and then just really able to afford the payment if you're leveraging it for a mortgage. It looks good on paper until that first check hits for your second home, and it's not a pleasant one. And again, I'm not trying to persuade anyone not to acquire a second, third, fourth home, but if it's for purposes of rental income or if it's for purposes of appreciation in your assets, just know that on average, the real estate market has generated 2 to 3% on returns, whereas the S&P 500, assuming 100% invested into that, has been on average of 10% returns. So you really want to see the risk-reward situation. Do you want to risk having a roof collapse, or do you want to risk a house catching on fire for 2 to 3%, or do you want to risk the economy going up and down and risk 10%? It's really a balancing act between everything. So the last item I'll touch upon is how to finance it. The easy way is just straight cash. You put it on a table, you get the keys to the house, and you're done. The better way, what I see now, given what rates look like, is to consider taking a home equity line or a HELOC off your primary residence and utilizing that for your second home. Again, it depends on your financial picture, but if you're able to support the mortgage payments or the additional payments for the HELOC, maybe it makes sense given that rates currently for mortgages are at about 2.5 to 2.75% for a 30-year and a 15-year at 2%, which is absolutely mind-boggling to me. So the other way you can think of it is really doing a cash instead of taking a HELOC, or you can leverage your assets as well. You can borrow against retirement, which I don't recommend, borrow against anything you collateralize. The one caveat I'll leave you with is that understand the power of leverage and understand the huge risk of leverage. If you all of a sudden can't pay that note on your second property, it doesn't just impact that property, it impacts your primary residence as well. So when things are good in the economy and we're fully employed and our earnings are increasing, all is good in the world. You know, maybe it makes sense to leverage, but know that the risk does exist that we could lose our jobs. The market could significantly decrease, and you know, if we're not careful, the leverage can bite us pretty hard. Okay, so we'll go one more slide up. We talked about the investment consideration. Just know on a second home, if you're not treating it as rental property, you're probably not getting a tax write-off for it or the itemized deduction for it. We're now limited to $750,000 for mortgage acquisition debt, which means if your first home has a $750,000 mortgage and your second home is $200,000, you no longer get a tax deduction for the $200,000. We talked about the state and local tax deduction, which is limited to $10,000. So if you have $10,000 of state income tax and property tax, and your second property is $5,000 of property tax, there's no tax deduction on that either. So from the tax side of things, it doesn't necessarily make sense if you're treating it as strictly a second home. All right, next slide. So we'll wrap up with this. If you think you're going to turn it into rental, make sure you have an exit strategy. Otherwise, you're going to be sitting with a utilized house that has multiple tenants coming in and multiple Airbnbers coming in, that has huge repair bills and a huge prep for market, prep to bring to market. And it's not just the upfront costs that you think you'll have with the day-to-day rental, but it adds on to the back end of it. So the one thing that I'll leave you with tax-wise is that if you rent out your vacation home or your second home, and let's say it's in, I'm going to use New York City, and it's right off of Times Square, and you're getting $10,000 a night as a huge, just conceptual idea, you can rent that out up to 14 days, and that is effectively considered tax-free income to you. So $140,000 in our example for having a highly desired location and rental property, or not rental property, vacation property that we just so happen to rent, we get a free lunch for that. So it's really nice if you have something that's on the beach in a city, something that has high demand. So you can kind of think about that as you're considering what we'll do with our vacation home or our second home many years from now. All right, with that, we'll leave you with, at the end of the day, the most important thing is really just to have a plan, figure out your timeline, your goals, tend to it, and watch it grow. There's no get-rich-quick scheme, of course, but there is having financial knowledge and the ability to implement that into your financial plan. And in doing so, we kind of make sure we review it every so often over time, and we just watch it increase and appreciate in order to meet our goals and objectives of our financial lives. So with that, we have a couple upcoming seminars that we just want to leave you with. They're in the slide deck, so you can look at them later. Lots of financial planning ideas, market updates, retirement planning. We always love talking with everyone, so please feel free to come into these seminars and also provide any questions you have. And that is effectively it. We do have a COVID resource center as well for anything COVID accounting, tax, etc. It's literally day by day, hour by hour updates for resources and regulations and legislation that's coming out. So it's a really nice part of our website that you can check to see what's going on in the world.
All right. Yes. Any other questions, anyone?
Oh, that's a very old picture.
Looks a little different, huh, Jordan?
That was a pre-COVID item.
Right. All righty. Well, with that, again, thank you everyone for joining us. If you have any questions, feel free to reach out. And I hope you enjoy this webinar. I hope you learned something new. So, all righty.
All righty. Thank you, everyone. Everyone have a great afternoon.
Thank you. Bye-bye.